Hi, hello, and welcome viewers for Success Formula for You channel. This channel is dedicated to share the knowledge that will be of use for you always. As far as accounting is concerned, whether you are a student, a professional, or an entrepreneur, if you have a clear understanding of the basic terms and concepts in accounting, you can handle any type of business accounting. As I have been receiving lot of requests to put cost accounting videos, you can expect my next video on cost accounting shortly. Income statement. An income statement, also referred to as a profit and loss statement, is a financial statement that shows the revenue, the cost incurred by the firm, the expenses made during the accounting period for which it is prepared. It also, above all, reflects the profit made by the firm out of its operations. Internal liability. All the financial obligations that the firm has to pay to its internal parties, like the owner, employees, etc., is referred to as internal liability. Inventory refers to the stock of raw materials, work in progress, finished goods that is held by a firm for the purpose of selling to the ultimate customers. Issued capital. It refers to the total number of shares that is issued by the firm to its shareholders. A journal is a book of original entry and it is the first record in which a firm enters its financial transaction. A journal entry is a record of the business transaction which consists of the date on which the transaction takes place, the page number of the ledger in which the corresponding entry is made, the head of accounts which is debited and credited, and the amount associated with such an entry. The process of recording the financial transactions in this book is what is referred as journalizing. A ledger is an accounting record of the firm that facilitates the transfer of all journal entries in a chronological sequence to the individual ledger accounts of all heads. The entry in the ledger is based on the entries that are made in journal, and this process of transferring the journal entries to the respective ledger account is what is referred as posting. Liquid assets refer to the cash equivalents which can be easily converted into cash within a few weeks or months. Example, certificate of deposits, promissory note, accounts receivable, marketable securities, etc. Liquidity in accounting terms refer to the ease with which the securities or any assets can be converted into cash at the marketplace. It refers to how easily an investment of a firm can be sold for cash. Manufacturing account is an account that is prepared to find out the cost of goods sold. That includes the cost of direct materials used in the production process, the purchase of raw materials, work in progress, direct expenses like the expenses incurred in the factory, the wages paid, etc. The main aim of preparing this account is to determine the manufacturing cost of the finished goods. It also helps in knowing the effectiveness of the manufacturing activities. Then, the cost of finished goods are transferred to the trading account. Market value or open market valuation refers to the price an asset would fetch in the marketplace, or it may refer to the market capitalization of a publicly traded company. Materials refer to the raw materials that are used in the process of manufacturing a product. Net income, also referred as net profit, net earnings, or the bottom line, refers to the accounting profit made by a concern after paying off all its expenses. Net margin, otherwise referred to as net profit margin, is a financial ratio that measures the net income earned by a firm as a percentage of its revenue. And the formula is net profit margin is equal to net profit by revenue into 100. A non-current asset is a type of asset that the firm acquires or invests, the benefit of which is enjoyed by the firm for years together. The liquidation of such assets cannot be made within one accounting period, but it will generate revenue for the firm over a long period of time. On credit means the payment of a sales transaction is postponed to a future date as per the terms of sales and payment agreed upon by the parties. Overhead refers to the expenses that the firm incurs for its day to day expenses like administrative expense, insurance, salary to office staff, etc. Outstanding expense refer to the expense which is due but has not been paid by the firm. Outstanding income refers to the income due to the firm which has not yet been received by it. Owner's equity referred to that proportion of the assets of the company that can be claimed by its owner if it is a sole trading firm or partnership and by its shareholders in the case of corporation. The formula for calculating it is as follows. Equity is equal to assets minus liabilities. Paid up capital. This refers to the amount of money that the firm has received by way of issue of shares to the shareholders. Payroll is defined as the process of paying salary to a firm's employees. The process starts with the preparation of a list of employees to be paid salary and ends with the recording those expenses. Present value is the current value of the future sum of money at a specified rate of return. The future cash flows would be discounted. The formula for that is present value is equal to cash flow at a period divided by 1 plus rate of return raised to number of period, actually the number of years. Price refers to the amount that a customer is willing to pay for a product or service. The difference between the price paid and cost incurred is profit for the firm. The profit and loss account is the most important financial statement of a firm that shows the net profit or loss made by the firm during that accounting period after deducting all the expenses incurred. It is one of the important statements, others being the balance sheet. Purchase returns or return outwards can be seen as a process where goods are returned to the suppliers because of being of defective quality or maybe in a damaged state. Receipts are documents that are prepared as a proof of financial transactions, especially when there is an inflow of cash, and that serves as a documentary evidence for the transactions, especially at the time of auditing. Retained earnings refer to the portion of earnings left with the firm after the dividends have been distributed to all the shareholders. Return on investment, also known as the return on asset ratio, is a profitability measure that evaluates the performance or potential return from a business or investment. The ROI formula looks at the benefit received from an investment or its gain divided by the investment's original cost. Revenue is the total amount of income generated by the firm out of its sales of the product or service that the firm deals with. Sales returns refer to the returns received by the firm from the customers to whom they have sold goods. The customers may return goods due to some fault in the product, or it may be of substandard quality, or maybe due to the fault in some packing or any other reason. Share capital is the money that a company raises through the issue of common or preferred stock. A single entry system of accounting is a form of bookkeeping in which each of a company's financial transactions are recorded as a single entry in a log. Transactions are recorded in a cash book, a journal with columns that organize transaction, details like date, description, whether it's an expense or income. Tangible assets are those assets which has a physical existence, which include cash, inventory, vehicles, equipments, buildings, etc. Trade payables are the firm's obligation to pay for goods or service that have been acquired by the firm from suppliers, the ordinary course of business. Trade receivables are the total amount that a company has billed to its customers for goods and service that they have delivered but haven't yet received the payment for the invoice. Trial balance is an accounting report that lists the closing balances of the general ledger accounts. The balances of the ledgers are added to the debit and credit columns. The total of these two columns should have to match. Variable cost are those expenses which vary directly in proportion to the volume of goods or service produced. A voucher is an internal documentary evidence for the expenses made by the firm or for the payment made towards the suppliers. Hope all of you found it useful. If so, kindly share my channel link with more people so that they also get benefited. I'm sure all those who are watching my video have subscribed. Do not forget to subscribe and click the bell icon for more and more useful videos. Thank you.